Have you ever wondered why, no matter what happens in the world, economic crises, inflation, market crashes, the wealthy always seem to come out on top? While millions of people struggle to pay their bills, the richest people on the planet are quietly growing their fortunes. And the gap between them and everyone else keeps getting wider every single year. This isn't a coincidence. It's not luck. And it's definitely not because rich people work harder than you do. The truth is, wealthy people play by a completely different set of rules. Rules that most people never learn because no one ever teaches them. Today, I'm going to break down exactly why the rich keep getting richer, what systems they use, and most importantly, how you can start applying these same principles to your own life, no matter where you're starting from. Let's get into it. The first thing you need to understand is the difference between how poor people think about money and how rich people think about money. And I'm not talking about mindset in a vague, motivational poster kind of way. I'm talking about concrete, measurable differences in behavior. Most people, and there's no judgment here, because this is how most of us were raised. Think about money in terms of income. You work, you get paid, you spend. That's the cycle. And if you want more money, the obvious answer seems to be work more, earn more, maybe get a raise, maybe get a second job. But here's the problem with that logic. Your time is finite. There are only 24 hours in a day, and you can only sell so many of those hours before you burn out. So if your only strategy for building wealth is trading time for money, you've already hit a ceiling, and that ceiling is lower than you think. Rich people understand this. They don't just earn money, they make their money work for them. They build systems that generate income, whether they're awake or asleep, whether they're working or on vacation. This is what people mean when they talk about passive income. And it's not just a buzzword, it's the foundation of how wealth actually compounds over time. An asset is something that puts money into your pocket. A liability is something that takes money out of your pocket. Most people spend their entire lives accumulating liabilities and calling them assets. They buy a big house, they buy expensive cars, they buy the latest gadgets, and they think they're building wealth. But if those things are costing you money every month, they're not assets, they're liabilities. Rich people do the opposite. They prioritize buying things that generate cash flow, rental properties, stocks that pay dividends, businesses, intellectual property. These are things that produce income over time, income that doesn't require them to show up and trade their hours for it. And here's where it gets really interesting. Once you have enough assets generating enough passive income to cover your expenses, you're financially free. That's the whole game. It's not about having $1 billion in the bank. It's about having enough income flowing in from your assets to sustain your lifestyle, without needing a job to do it. Albert Einstein reportedly called compound interest the eighth wonder of the world. Whether he actually said that or not, the principle is undeniably powerful. Compound interest means you earn returns not just on your original investment, but on all the returns you've already earned. It's interest on interest, growth on growth. Here's a simple example. If you invest $10,000 at an average annual return of 8%, after 1 year, you have $10,800. But in year 2, you earn 8%, not on $10,000, but on $10,800. And in year 3, you earn it on even more, and on and on. Over 30 years, that original $10,000 grows to over $100,000, without you ever adding another cent. You didn't work for that money. Your money worked for you. Now imagine if, instead of $10,000, you started with $100,000 or $1 million. The numbers become staggering. This is exactly why wealth accelerates over time. The rich don't just get richer because they earn more, they get richer because compound growth rewards those who already have capital. But here's the good news. Compound interest works for anyone who starts. The catch is time. The earlier you start, the more powerful it becomes. A 25-year-old who invests $200 a month will end up with significantly more than a 40-year-old who invests $500 a month, even though the 40-year-old is putting in more money. Time in the market beats everything else. Rich people don't just have more money, they have more access. Access to information, access to opportunities, access to other wealthy and influential people. And this access compounds just like money does. Think about it. If you grow up wealthy, you probably go to better schools. Those schools connect you with other future leaders, entrepreneurs, and decision makers. You get internships at top companies because of who you know. You hear about investment opportunities before they go public. You have mentors who guide you. You have a safety net if you fail, so you're more willing to take risks that could lead to massive rewards. None of this is available to someone starting from nothing, and that's a real structural disadvantage that we should acknowledge honestly. But, and this is important, it doesn't mean those advantages are completely out of reach. The internet has changed the game in a significant way. Today you can access the same books that wealthy people read. You can follow the same investors. You can learn the same strategies. You can build networks online. You can find mentors through social media and communities that simply didn't exist 20 years ago. Here's a fundamental truth about the tax system in most Western countries. It is designed in a way that rewards wealth over labor. When you earn a salary, you pay income tax on every dollar you earn, often at rates between 30 and 50% depending on where you live. That money is taxed before you even see it. But when rich people make money, a huge portion of it comes not from salaries, but from capital gains, profits from selling investments like stocks or real estate. And in most countries, capital gains are taxed at lower rates than ordinary income. On top of that, wealthy individuals and corporations have access to a wide range of deductions, write-offs, and legal structures that allow them to reduce their taxable income dramatically. A business owner can deduct their car, their home office, their travel, their meals, all as business expenses. An investor can defer taxes on profits by reinvesting into other assets. These strategies are completely legal, and they're available to anyone who sets up the right structures. But most people never learn about them. For most people, debt is something to be afraid of, and in the form most people experience it. Credit card debt, consumer loans, buying things they can't afford. That fear is completely justified. High-interest consumer debt is wealth-destroying. But wealthy people use a completely different kind of debt. They use what's called leverage, borrowing money to buy assets that will generate more return than the cost of the debt itself. Here's a simple example. Let's say there's a rental property worth $500,000. A wealthy investor doesn't necessarily pay cash for it. They might put down $100,000 and borrow the other $400,000. The rental income covers the mortgage payments and then some. Meanwhile, the property appreciates in value over time, so the investor is building equity and generating cash flow, all while using someone else's money to do it. This is how real estate empires are built. This is how private equity firms operate. They use leverage to amplify their returns in ways that would be impossible with just their own capital. Now, leverage is a double-edged sword. When things go right, it multiplies your gains. When things go wrong, it multiplies your losses. This is why financial education and risk management matter so much. But the point is, debt itself isn't inherently bad. It depends entirely on what you use it for. The first habit is paying yourself first. Before you pay any bills, before you buy anything, you set aside a portion of your income for savings and investments, not what's left over after expenses, the first dollars that hit your account. Most people do the opposite. They spend first and save whatever's left, which is usually nothing. By automating your savings before you even see the money, you eliminate the temptation to spend it. The second habit is continuous financial education. Wealthy people read constantly. They study markets. They follow economic trends. They understand how different asset classes work. They're always learning. And in a world that's changing as fast as ours, this isn't optional. It's a competitive advantage. The third habit is surrounding yourself with people who challenge you financially. Your environment matters enormously. If everyone around you has the same relationship with money, spending to impress, avoiding the topic, seeing wealth as something for other people, that becomes your reality too. Find communities, books, podcasts, mentors that expose you to different ways of thinking about money. The fourth habit is taking calculated risks. Wealthy people are not reckless, but they are willing to act on opportunities that most people are too afraid to pursue. They understand that staying in a safe job with a safe salary might actually be the riskiest thing you can do in the long run, because you're one layoff away from losing everything, with no other income streams to fall back on. The system is not entirely fair. Generational wealth gives some people a head start that others will never have. Structural inequalities based on race, geography, and social class are real, and they matter. I'm not here to pretend that if you just invest wisely and read the right books, you'll automatically end up wealthy. Life doesn't work that way. But here's what I also believe. Financial literacy is one of the most powerful tools available to anyone who wants to improve their situation. Understanding how money works, how wealth is built, how taxes function, how to use debt intelligently, this knowledge can genuinely change your trajectory. Not overnight, not without effort, but it can change it. And the fact that this knowledge isn't taught in schools, that most people go through their entire education without ever learning how to manage money, invest, or build wealth, is itself a form of inequality. Because the people who do learn these things, usually from wealthy parents or elite institutions, have an enormous advantage. So, by watching this video, by seeking out this information, you're already doing something that puts you ahead of the majority of people. Don't underestimate that. Step 1. Get clear on your current financial situation. Know exactly how much you earn, how much you spend, and where every dollar goes. You can't fix what you can't see. Track your expenses for 1 month, and I guarantee you'll find money you didn't know you were wasting. Step 2. Eliminate high-interest debt as quickly as possible. Credit card debt at 20% interest is wealth destruction. Every dollar you pay in interest is a dollar that could have been invested. Attack this aggressively before you do anything else. Step 3. Build an emergency fund. 3 to 6 months of living expenses in a liquid savings account. This is your foundation. Without it, any unexpected expense forces you into debt, which sets you back every time. Step 4. Start investing, even small amounts. Open an investment account. Start putting money into low-cost index funds. You don't need to pick individual stocks. You don't need to understand complex financial instruments. A simple diversified index fund capturing the broad market has historically returned around 7 to 10% annually over long periods. Let compound interest do the work. Step 5. Look for ways to add income streams. A second job, a freelance skill, a small online business, a rental property, anything that creates income beyond your primary salary. The more income streams you have, the more resilient your financial life becomes, and the more capital you have to invest. The rich keep getting richer because they understand how money works. They invest early and consistently. They use leverage wisely. They build multiple income streams. They minimize taxes legally. They think long-term when everyone else is thinking short-term. None of these strategies are magical. None of them are secret. They're available to anyone willing to learn and apply them. The difference is that most people never take the time to understand them, and so the gap between those who do and those who don't keeps growing. You now know more than the average person about how wealth is actually built. The question is what you do with that knowledge. Start small if you have to. Start with one habit, one account, one investment. But start. Because the one thing compound interest cannot work with is zero. And the one thing time cannot give back is the years you didn't use it. The best time to start was 10 years ago. The second best time is today.